Japanese candlesticks in Forex. Now, the reason I am specifically stating that we're looking at Japanese candlesticks in Forex is because the traditional use of Japanese candlesticks occurred when in trading in the futures markets, and the futures markets have a very distinct opening time and a very distinct closing time on a daily basis, as do the equities markets. And as you know, the foreign exchange market moves rolling 24 hours a day, approximately 5.5, 6 days a week. And therefore, there are a lot of formations that will not be used in our practice of trading in the foreign exchange markets because quite simply we don't have the distinctive opens and closes that the futures and equities markets have, offering very distinct candlestick formations that are applicable to that type of market environment. And therefore we're just going to look at some very specific candlestick formations that are helpful to us in trading the foreign exchange market. The first thing we're going to do is we're just going to do a quick overview of what the anatomy of a Japanese candlestick, or understanding how to read a Japanese candlestick. So for example, this is a bullish candle. So price has moved up in this period, and what it does is it represents price action. Now in this particular case, this here is the body, and on either end we have a wick in this candlestick. Now, because this is a bullish candle, price has opened at this point right here, the low of the body, and at one point during this time period, price moved all the way down to this low and rallied, and at one time price traded all the way up to this high and closed right here at the end of the time period. Now each of these candlesticks will represent a specific time period, whether it's 5 minutes, 15 minutes, 30 minutes, an hour, 4 hours, daily, weekly, etc. So what it does is this candlestick represents trading price action within a given time period. So if we have a 30-minute chart pulled up or a 60-minute chart pulled up, for example, this whole candlestick will represent the price action that has occurred during that 60-minute period. So again, we have the open. Price opened at this level right here. At one point it traded all the way down to this low, and price traded all the way up to this high during the time period and closed at this point right here, which makes it a bullish candle. If we move over to the next time period, after 60 minutes, this comes to a very distinct close, and then the next candlestick will open up. And at one point, price traded all the way up here. Price moved all the way down to the bottom of this wick. And if the close is lower than the open, then we would have a bearish candle. And as we can see here. And then therefore, at the end of this time period, then the next candlestick would open. So we have a bullish candle and a bearish candle. Again, just to give you a bit of a different visual, the bullish candle is green in this case. Price opens, trades down to this low, as high as this high. At the end of the time period, price was right here, and it closed. Next candlestick opens, trades up to this high, down to this low, and closes. The close is lower than the open, making it a bearish candle. Having a look at what this would appear like on a chart, we see here we have a bullish candle. The bullish candle closes for this time period. The next one opens, price trades down here all the way up to this high and closes here. The close is higher than the open, making it a bullish candle. And the next candle opens and the close is lower than the high, making it a bearish candle. We use candlestick charts, and this is just an example of a candlestick chart. The white candlesticks are bullish, and the red candlesticks are bearish, meaning that the price closed lower than it opened. And as you can see, we see more bullish candles in this up move than we do bearish candles, and we see more bearish candles in this down move than we do bullish, and so forth. The reason why we use candlesticks is because they're very visually friendly, and they're a lot easier on the eyes when staring at a computer all day, but they give us a real sense of what's happening with price action on a period-to-period basis. Again, candlestick formation is useful in Forex, and I will say that they are it is more limited in our use of Forex. Candlesticks used in Forex are much more limited than they are in markets that have distinct open and close. Some of my favorites are here we have a hammer reversal. This simply suggests that during this time period, price took a significant spike lower, but was rejected and came all the way back up. Therefore, we had the bulk of the price action trading at this price point up here, and the bears made an attempt to go lower, but were quickly rejected by the bulls. So this is a bullish hammer. This means that the bears try to move downwards, but were rejected by the bulls, or just didn't have enough strength to follow through. Similarly, here we had the bulls making an attempt to go higher, and they were rejected, suggesting that the next move could be down, as there was no follow-through in buying interest. These are handy candlesticks when seen at the end of a nice trend, or if there's a significant level that price is testing, either at this low or at this high, and it gets rejected, and it can strongly suggest a potential move in the opposite direction. Here we see an up move in this case, and we see two hammers, two attempts to go higher, another attempt to go higher to the exact same price as the previous, and then again on the third another, and then finally it's rejected and we get follow through to the downside. A doji star is an indication of a reversal. Here we had price open here, and price made a move higher and was rejected, and moved lower and was rejected, and price closed at the same price that it opened, representing indecision by the markets. These are commonly seen in periods of consolidation or sideways movement, and they'll appear, you'll see many of these, particularly during very quiet times in the market. These can be very handy when we see price has made a significant move up or down, either up or down, in this case up. We see a doji. It's actually a long-legged doji, which means it has a very long wick on either side of the open and close price here, and then price simply makes a decision to reverse at that point. It makes its attempt higher, decides it doesn't want to go any higher, and it makes a decision to reverse. Then at the end of this long run, we see another doji, which indicates indecision, and then we see price start to move now again in the opposite direction. There's various types of dojis, and we have just a regular doji, which typically you'll see this one here with a smaller framework in periods of consolidation. A long-legged doji we may see during times of economic reports, or when there's a lot more volatility or a lot more liquidity being pumped into the market, and therefore there's a lot more price action moving to either side of the point of indecision, which is here where price had opened and closed. And these are, the longer the legs, the more I prefer it. I really like these dragonfly dojis when I see them at the end of a trend or at the end of a intraday price move. The dragonfly doji can suggest that there is no further interest. For example, in this case, no further interest on the downside, and that the next move could be up because the open and close are close to the top of this frame. Gravestone doji is not very common at all. It simply, once again, means that there's an exhaustion to the upside in this case, and price opens and closes at the base of the candlestick, or in the opposite at the top of the candlestick if this were turned upside down. A bearish doji star, often we will see a candlestick that represents a parabolic move in the market or a significant up move, and it is followed by a doji star, which often after a significant move the market needs time to digest the move and will go into a point of indecision, or liquidity will lighten up, or they'll have to decide whether or not they want to continue moving up or go down. But usually after a parabolic up move, price will often reverse and start to move in the opposite direction or retrace. A bullish doji star will occur after a parabolic or significant down move, and you'll actually see that price will often open and close price will be beyond the closing price of the low of this candle, and then price will have to fill its gap or start to just, it often will see a retracement or potential reversal after such a parabolic move, and in this case it would be bullish. Looking at some more examples, we see here our long-legged doji again after a nice up move, and then some volatility. Price opens and closes the same price, representing indecision, and again the same. After prices move down considerably, we have a similar pattern at the bottom of the move, and price moves upwards. Let me tell you what I like about this one. Here, price has, this is, we're going to get into, give you a bit of a preview of some other of the items and tools that we're going to talk about in this section. But here we have price has established a high, and then we go into this consolidation, and price moves up again, making a run at these highs, and we see a spike through, and price fails to hold above the high, and it forms this really nice dragonfly doji. As the market digests the move and decides that it is unwilling to move and hold above the previous high, then we see that once price has decided, or once the market has decided it's not going to move higher like this, then you typically see a profound move in the opposite direction, and this dragonfly doji gives us a real nice indication on this time frame of price moving lower as it does. Here's an example of a gravestone doji, and again what I like about this is how price established a high here, and as price moves forward it continues to struggle. Here we see a bear hammer and another bear hammer, and then finally confirmed with the gravestone doji, and price starts its move downwards and trend downwards from this point. These candlesticks are just confirmations of what has already happened and been established up here, a very specific price point that has been established up here by the larger flows. Here's a bearish doji star. We see a real nice up move, and then followed by a very distinct bearish doji star, and it's complemented by a bearish hammer, and then we just see a spinning top here, which we'll see those all over the chart, and then we see a nice move downwards. The bearish doji star once again representing a point of indecision and reversal. This is a bullish doji star, again a move down followed by a doji star, And here we see our move down and then a nice doji star at the end of a move, and price then follows with an up move. What I want to say about these candlestick formations is that we look for these candlestick formations at very specific points in the market. For example, here, this must be a clearly established base as determined by the other tools that we are going to bring into lessons from this point onward. We don't want to just trade candlesticks standalone. We want to trade them in combination with the other tools that we're applying to the market. Spinning tops, of course, it just simply represents a neutral stance by the market. Here we just see price moves lower, moves higher, opens and closes within a very distinct range, and these are just very common, and we'll see a lot of these, but they just simply represent a neutral stance in the market. Often found in periods of consolidation. Here the market spends most of its time in consolidation, but spinning top in consolidation, spinning top reversal, all right, another spinning top consolidation, but usually represent a neutral stance by the market. Railroad tracks are a fairly commonly seen. Once again, a price makes a move lower from this point of consolidation, makes a move lower, and is quickly rejected and starts to move up, trading above this level, and we see it followed with an up move. Now, once again, the base of this railroad tracks, if you're going to trade this railroad track, it must be supported by other technical tools. For example, this base here, this base should be a distinct level of support or resistance as established by the other tools that we are going to discuss. One thing I want to point out here is that you see how price opened here, closed down here, then the next candle price opens here and closes up here. Well, on a higher time frame, this would appear as just one long wick. It might appear as a candle similar to this one. It will be a long wick down, and then it was rejected. But here we actually see, because it's broken down into a smaller time frame, we actually see the full-bodied candlesticks formation here on the smaller time frame. Looking at several different candlestick formations here. As I mentioned, you see this base of support here, and when we see a long-legged doji come down to this base of support right here, then that becomes tradable. And then it is followed by an up move. We see a railroad track, and the railroad track is later confirmed by the hammer, and then we see a down move as a result. Then a retracement, a long-legged doji with a small body, and then followed by a down price move and another railroad track, followed by a small up price move. So this slide just gives you an idea as to how some of these candlesticks can present themselves through the course of intraday trading. One of my favorite candlestick formations, which I might even trade standalone, is when I see a tweezer formation as we see here. So just think about this now. This typically indicates failure of a market attempt to push price higher beyond a distinct level. Clearly, price opens down here. It can either open here or here. Doesn't matter if this is a bullish candle or bearish. Think about it now. Price moves all the way up here to this specific price point, and it gets rejected. Comes all the way back. The next period opens up, and this period can be 30 minutes, 1 hour, 2 hours, 4 hours daily, and price moves all the way back up to or about the previous price point that was established, and it again gets immediately rejected. The faster it gets rejected, the better. And the higher the time frame that these candlesticks represent, the better. The higher the probability. Okay? The higher probability is associated with the time frame of these candles, the higher the better, and the speed at which this price is rejected. The faster the better. I love these candlestick formations, particularly if they're being rejected at a very clearly defined technical level at the top, or likewise at the bottom. Example of tweezers. Now these are not the perfect exact tweezers like we saw here, which brings a point, and that is that the more symmetrical these candlestick formations are, the higher the probability that price will come to fruition, or the move that you anticipate will come to fruition. Not perfect tweezers like we saw. It will never be technically perfect, but a real nice rejection at the highs, an exhaustion, followed by a nice down price move. Here we see many attempts to fail to make new lows, concluded by a very distinct set of tweezer bottoms at these lows, which gives it even more support of it moving higher, immediately followed by an up move, and then price comes down and retests one more time, and then we have a railroad track that confirms, followed by a nice move. I will say that there is probably some profit even just from this point here to this point here, but price comes all the way back down, forms a railroad track, and then moves up nicely. Again, here we see price has established a very distinct high point right here, and then it consolidates, probably a slow time during the market, and then we start to see as liquidity picks up, price tries to make a higher high, it rejects, forms a nice set of tweezers, and begins to drift lower. And sometimes these things take time to come to fruition. So it drifts lower, and then this candlestick right here is a real nice confirmation that the market is unwilling to go higher, and we see a nice spike up, which is quickly rejected. And when you see that, that can lend to another whole trade altogether, and we see a nice move down following. Again, we see the same characteristic. We see the high, price coming up, making attempts to move above the previous high, and we see real weakness here. You see the dragonfly doji slash tweezer, and another attempt, quickly rejected, and then a really nice move downwards. Now, these candlestick formations, don't just trade a candlestick formation verbatim. What you have to look at is you have to think about what the market is doing behind the candlestick. What is it in the market that's causing the candlestick to make that formation? Why is it that the market is presenting itself through the candlestick in the way that it is? What's going on behind the scenes? And it's important that you're able to discern that or distinguish that when price is active in the market. I want to know what's going on. Sure, we just see a nice tweezer here, but the point is that it's trying to make a move above this previous high, and it's not. It's not getting above the high, nor is it trading above the high or holding above the high. And then we see a nice rejection once the market decides it's not moving higher. Here we see a nice run, and then a bear hammer, and then followed by a retracement. But what I like is this candlestick right here. This is further confirmation that this high is likely to hold. We see price trading below this range low, and the candlestick moves up, is quickly rejected, and we are followed by a continuous down move. Then we see another hammer of the bulls trying to make another attempt to go higher. It is rejected, and then we move down. Here we see a nice little retracement represented by the dragonfly doji, and another dragonfly doji, and the downtrend continues. Some very nice hammers confirming the down move that started at the top. I like this because here is a clearly established low, and this candlestick formation comes down and is quickly rejected. Therefore, again, we want to look at what's going on behind the scenes. This is a nice candlestick, but what it tells us is that is how this was rejected. Sure, we can see now that price is trading above this previous low, but it shows us how quickly price was rejected and what time period price was rejected, therefore helping us in our decision as to whether or not we want to buy at this point. So to bottom line it for you, when trading foreign exchange, I like long wicks. Long wicks are good when trading foreign exchange. A lot of the other formations can be discarded, but the wicks are the storytellers. Another nice tweezer bottom at this low, confirmed by a hammer. Again, price tries to make new highs, and we see a nice long wick here, confirming that the price is rejecting new highs. And then we see a real nice support becomes resistance, a rejection to move higher, and then price moves lower. And we're going to learn all about these kinds of things and how to trade them and really make a lot of profit from these. And again, we see price comes down, tries moving lower than this low here, and is rejected, and we see a nice retracement. Again, double top, price rejected. This doji was the confirmation that price was being rejected before the down move. Here we see a railroad track top, followed by confirmation with a hammer, and another failure here to make a new high. Then the move starts. You're going to see this pattern over and over and over again, and this is where candlesticks can really help us. Then we're going to look at how to combine candlesticks with major reversals. And here we see, for example, price moving, slowing down, consolidating, and then we see a nice tweezer top, and then we see a breakdown through the trend line, okay, and then further through the trend line, test the backside and down. And what we're going to do is we're going to start bringing our candlesticks into the other tools in the course. Consideration for trading Japanese candlesticks: most formations will not be textbook perfect in appearance. Okay? Do not look for perfect textbook candlesticks to present themselves in the market, because you may be waiting a long time for that perfect trade. Has the market been trending, or has it been consolidating? Has there been volatility in the market? Is the market showing signs of exhaustion, or is it at the end of a big move, or are we looking for a distinct candlestick formation at the exhaustion point of a trend? Are the formations occurring within a consolidation? If so, they are less likely to be sending a clear message of a move. So what this tells you is that you may have a candlestick formation that may look real nice in a trending and volatile market, but if you see the same candlestick formation in a consolidating market, then the probability associated with that formation is typically less in a consolidating market. Is the market at early peak or late hours of the session? Peak hours are typically optimal, but sometimes when liquidity starts to dry up, and if we're later in a session, certain candlestick formations will lend themselves to good trading opportunities, as we will study later in the course. Is the candlestick formation being established at what's called a key level? And we're going to look at key levels because it is best if a price level is already established and then we have a candlestick formation to confirm the move? Does the formation agree with other technical considerations? Does it lend or does it synchronize well with other chart patterns like pivots, Fibonacci, support resistance, trend lines, and other tools, indicators, and so forth? And finally, can you afford the trade? The candlestick formation should be one of multiple factors suggesting a potential price move. Don't just trade candlesticks standalone.